Support and resistance are the backbone of technical analysis. These invisible levels act like magnets and barriers for price. Support prevents prices from falling further, while resistance keeps them from rising. In this chapter, we'll break down what support and resistance are, why they form, how traders use them, and how to spot them on a chart. Support is a price level where buying interest tends to emerge. It's often seen as a floor that supports the price from falling further. It forms after a downtrend slows and demand increases. Traders expect price to bounce at this level. The more times price touches support without breaking it, the stronger the support. Resistance is a level where selling pressure typically appears. It acts as a ceiling that prevents prices from climbing higher. It forms after a rally where sellers begin to take profits. Traders expect price to reverse or stall at this level. Like support, repeated tests without breakouts strengthen its credibility. One of the most powerful concepts in chart reading is that once support is broken, it often becomes resistance when price retraces, and vice versa. This happens due to psychological memory. Traders who miss the move jump in when price revisits the level. It creates great entry or exit zones. Static levels refer to horizontal lines, usually based on previous highs and lows. Dynamic levels include moving averages, for example 50 or 200-day, trend lines, and channels. These adjust over time and provide dynamic support resistance. Entries are made by buying near support and selling near resistance. Stops are placed just beyond support resistance to manage risk. Breakouts, a strong break above resistance, signal bullish momentum, while a breakdown below support signals bearish momentum. Confirmation through volume spikes or candlestick patterns, for example, engulfing hammer, around these levels improves reliability. Support and resistance levels help identify potential price turning points. They form the basis for many trading strategies and risk controls. Role reversals offer powerful setups for breakouts or reversals. Combining S and R with patterns or indicators increases accuracy. Next up, in Chapter 3, we'll look at chart patterns like triangles, flags, and head and shoulders, and how they signal market psychology in motion.